Good morning, everybody. Welcome to the Flow Show, Thursday, 4th of April. And a busy week going on by the looks of things. So I missed quite a few things going on in my couple of days off. But I'm back and ready to get stuck into it. Thanks as always to K-Man for holding the fort. Good morning, mate.
Hey, good morning, Ryan. Welcome back. I hope you had a nice few days off over Easter, family time, quality time.
Yeah, very much so. Quite busy. I don't think I got to bed earlier than midnight every day.
Oh,
We
really?
were out and about, but yeah, good to see some family and see some old sights in London as well. So
Yeah,
good
lovely.
trip for me and the kids and the wife. And yeah, all back and ready to do battle with markets again. So let's get stuck into it. Over in Japan, the former top currency diplomat Watanabe says Japanese authorities likely to not intervene unless the yen falls sharply below 155 that's in dollar yen. So that's his level that he thinks they're going to intervene at. We still got this undecided stuff going on at 152. Still quite an amazing level this one's proving to be. We've had the regional surveys out, or regional quarterly reports from the Bank of Japan, and the assessment has been cut in 7 of the 9 regions. Many regions said that wage hikes are expected to broaden among smaller regional firms. That's good news for the BOJ. But they said branch managers must watch wage developments carefully. Some firms may be cautious about raising pay due to severe business environment. They said a few regions also said that some firms were holding off on price hikes and were actually cutting prices for some goods. That's not good for the BOJ on the inflation front. The Osaka branch manager highlighting the differences that we get in FX. There's always 2 sides to a story when it comes to FX strength or weakness. He said that weak yen benefits sectors dealing with a booming inbound tourism and exports in the Kinkai Western Japan region. Some small firms and manufacturers, though, are facing rising costs from a weak yen. So weak yen is good for tourism, good for exporters, not good for manufacturers and for import costs. So 2 sides to the story there, and says that many regional banks in Western Japan raised the deposit rates after the end of negative rate, but are struggling to hike lending rates amid intense competition. So savings rates might have raised up a bit, but actually trying to make money from lending rates is proving a bit more tougher to pass on the potential those increases in rates. Well, call them increase, the end of negative rates, shall we say. So that's going to keep rates depressed amongst the banks. Over in Australia, well, we might as well have a look at it. We've got all the PMI data coming out overnight. Where are we? Let's go down to here. So over in Australia, they use the services PMIs. Good improvement there, 54.4, beating expectations, and last month as well. PM Albanese in Australia says, we hinted at further relief for energy bills will be coming in the May budget. They've got in place measures to, let's call it, suppress the prices of energy costs for businesses and for families, and they're looking to potentially extend that in their May budget, which means more fiscal spending, shall we say, or fiscal money being used for those relief efforts, but it also means that potentially there's inflationary pressures in the pipe if those ever get stopped. And you've got to know that if you're getting a relief in one hand, they're going to be taking it away with the other somewhere down the line. So that's going to impact the fiscal side of things in Australia. Over in Switzerland, there was some justification from the data as to why the SNB decided to cut rates. Swiss CPI fell to 1%, was expected to rise to 1.3 from 1.2. but it came in much softer. Core CPI also coming in softer, was expected to rise a pip to 1.2, came in at 1% exactly. So weaker inflation picture there. Would they ever had a hint of these numbers, Kay, before their meeting the other week?
Not these ones, because actually Jordan was expecting the CPI to tick up a little bit the start of the year, but they are not getting any of it. So no, I don't think they had the numbers. They should be as surprised as we are. Now, it's always good for somewhere for the Swiss corporates who were moaning for months that the Swiss franc was too strong. It was hurting their economic models. So all of this should be reasonably good news for those people, and keep the expectations for perhaps another quarter alive in where is it, June, right? Let me quickly get my paper. I think they so 3 months is probably going to be June as well. Yeah, the 20th of June. That's after the ECB and the next and the FOMC in June. Yeah, so that should keep the hopes alive for them as well to lower those rates a little bit, and to actually send the Swiss franc a bit weaker, so they can export more again and make more money again.
Yeah, exactly. They need to dig into that big loss that they've been covering for a long while, and they need to do better on their stock trade. They should be making a bit of profit, given them what stocks are doing. Yeah.
Oh yeah, what we've seen since the start of the year, that must be they must be making S&B hedge fund must be making back a lot of money what they lost over the past year and a half.
Yeah, maybe they stuck it all in ARC, and that's why they suffered all those losses.
Oh,
but yeah, anyway, we'll see what those numbers end up looking like this year.
Yeah.
Over at the ECB's to cost says Eurozone inflation data was positive. That was the softer inflation numbers that we saw. Says that the central scenario points to a first rate cut in June. So another one in the June camp for that. This morning we did get PPI data out from there, and PPI coming in not as negative as expected. Minus 8.3% was expected to come in, minus 8.6%, still a big negative number. The prior got revised up as well from 8.6 to 8% month on month as well, just coming in a little bit softer. Still, all these numbers have got negatives on them, so that's going to keep the disinflationary pressure coming in, although this is obviously lagging behind the CPI numbers that we've got. We had the UK DMP Decision Making Panel survey on inflation, 1 year inflation expectations coming down to 3.2% from 3.3% previously. 1 year CPI expectations are a little bit softer there, but well above where the Bank of England would like it. We'll go through all the other PMIs as well while we're here. Spain seeing a decent improvement, 56.1, beating forecasts and higher than last month. Italy as well, beating forecasts, higher than last month. Even France putting in a better performance, still negative, but beating expectations and higher than last month. Sorry, that was the composite. In the services, it beat expectations, but was a pip lower than last month. Germany as well, moving into expansion. Whoopee, go Germany. Beating those expectations and a rise on the month. Maybe they've seen the worst of things. Maybe not in manufacturing, given the numbers over there, but services doing better over there as well. That helped drag the Eurozone number up to 51.5, better than expected as well. UK services disappointing, coming in softer than the flash, 53.4, came at 53.1. So that confirmed a bigger drop than we saw from the prior month, February, 53.8. So not overly good. And the comments. The comments in most of these PMIs, bar France, were that inflation. Bar Spain, were that inflationary pressures are still highly evident. Italy seeing some increased inflation pressures. A lot of these pressures coming from wages, but there are also pressures from input prices and the prices being charged. A similar story there. In the UK, the comments were a little bit less bullish, shall we say, than it has read in recent times. So maybe this pickup we've seen in the services might already be running out of steam. We'll see if that is the case in future numbers. Coming over to the US, and we'll start with what we got yesterday. ADP showed no wobbles there, 184K, higher than expected, higher than last month. So no real wobbles or worries there ahead of Friday's NFP. I'll put the link up to INFP competition shortly. That's open and up and running if you want to have a guess there for tomorrow. In the details for the ADP, though, there were some inflationary pressures. They note some wage numbers there. They have an indicator for job stayers, so people staying in jobs. Now that fell last month to 5.1% and came in unchanged in yesterday's report, 5.1%. However, job changes, so people who moving jobs, pay rose from 7.6% to 10%. So there is still some higher wage pressures there from firms trying to tempt workers to join them, so offering higher wages. That is a bit different to what we've seen in the quits numbers in the JOLTS report, which has been a bit softer. And the quits numbers is an indicator of people who are voluntarily changing jobs, usually because they're moving up the ladder. So that number, a bit of odds there between the JOLTS quits and the changes there, although JOLTS is a month or so behind this data. So that may be something that's reflected in latter data points. But okay, a bit of a mismatch there, although it's you can't really say it's 100% correlation.
Yeah, absolutely. Because in former numbers, and even if you dive into the ISM, then with the employment index remaining sub 50, it's a bit of a mismatch compared to what we saw in the JOLTS, because the quits rate actually dumped quite a bit. And in combination with some data that we had before, it may actually put a bit less pressure on labor costs. So yeah, I think tomorrow that makes tomorrow for a very interesting read. Yesterday I said on the F.A.C.E show, I said perhaps the combination of what we're seeing yesterday then between the ISM and Powell speaking may actually be a bigger mover than what we are going to get at the end of the week on the NFP. But it makes things it spices things up a little bit again. This being said, we saw decent moves on the back of yesterday's releases and over positioning, I guess, in a way as well.
Yeah, I was going to say, because the ISM overall it was a positive number, but the details looked much softer. New orders down, as you said. Employment lower or staying negative. There, 48.5, still in contraction, and this is the biggest sector versus manufacturing. Also, that prices number coming down as well. I wasn't about. Did that spark the sell-off in the buck? Because it seemed to come around that time.
I mean, it just we had I think a 10 pips or so move when it came out, but then it did weigh on the dollar, and I think the market, as I said, was likely a bit overpositioned. We had decent levels as well, which I spoke about in for instance in the Aussie just below 65, in the euro dollar in those low 107s. Cable respecting that 125.40 down to 125. And although I was relatively positive on the dollar until then, I really had to revise my opinion and went out of a lot of dollars that I actually was running. before the real move lower started. It's yeah, it's over positioning, but also the people, as we are in this employment week. I think people are looking for potentially a weakening or rebalancing job market, because as I told you, Powell told us last Friday that that the dual mandate comes, the second part of the dual mandate comes back to the fore. And so even if you get sticky inflation numbers, if you combine it with a weaker is also a big word, but if you combine it with a slightly less buoyant labor market, which we are in the thick of it now, I think that's what the market is looking at, despite what's going on the yields, despite what's going on in the rest of the world. But that for the dollar bit. And then we also have to note, because there's always a second part to the to any dollar pair, is that we have to admit that the euro, the Aussie, Kiwi, even if the dollar rallied in the start of April, defying the seasonals at the end of March and stuff, those currencies remain relatively resilient. And it's still one big pot, we can say, but we can also not deny that there are perhaps a little bit of green shoots in the rest of the world as well. So it's a bit of a combination, I think, and the market being a little bit overconfident and a bit over-focused on when the stock market came down, when the US yields rallied, and just diving into dollar loans again, and now needing to once more reassess and potentially reprice.
Yeah, I mean, it is a very messy picture. Well, I'm going to talk about prices in more detail, but you know, seeing the dollar weaken while yields are up here, it's another one of those things that just you know, doesn't sort of fit the recent narrative at the moment, which you know, you've got to expect in trading. Nothing is all, you know, what's the word I'm looking for? Correlations. Correlations, you know, they break down.
Well, I mean, the correlations, I mean, one after the other just gets thrown out of the window. And then,
yeah.
But then, like 2-3 days later, it comes back with a vengeance. I look at the Aussie, and compared to copper, for instance, it completely ignored the copper rally for a week. And now all of a sudden, it catches up in a pretty big way, we can say, because Aussie is 1.5% higher.
Yeah, very much so. Very much so. Right, so we had all that data. Then we had a few Fed speakers out, including the main man himself. But we'll start with Bostic. And he said the economy is maintaining the strong momentum it has had. Says here, I think you can still get growth and get inflation to continue to come down. So that soft landing narrative. He says that's partly why he changed his forecast, as the Fed would have to be more patient than expected. And that's why he's now still forecasting only one rate cut this year. He was a 2-rate cutter, or 2-cut rater, however you want to call it. Says the road is going to be bumpy, and over the last several months, inflation hasn't moved very much relative to 2023. So a few more Fed heads saying that inflation hasn't actually moved a lot. Well, going on for 9-10 months now. Fed's Kugler said some lowering of rates this year is still likely appropriate, and that we should withhold judgment on the recent inflation data. If conditions change, then he's prepared to change the policy outlook. Now, Fed's Powell was out, and from what I can see from the comments, didn't really change his tone. Said there is time to deliberate over rate cuts. If the economy evolves as the central bank expects, most federal or most FOMC committee participants see it as likely appropriate to begin cutting policy at some point this year. So to do so, the Fed still needs greater confidence of inflation moving sustainably down towards its 2% target. It's too soon to say whether recent inflation readings are more than just a bump, and that the labour market rebalancing seen in data on quits, job openings, and other employer and worker surveys, and the continued decline in wage growth is heading the right way. Risks to cutting rates too soon, or there are risks to cutting rates too soon, as well as waiting too long. So those comments, Kay, I mean, I've read headlines saying that it's Powell mainly saying that rates are still going to be cut irrespective of what the data's doing, so thus putting a more dovish slant on it. But those comments are still pretty much the same. So again, you know, reading those comments, I thought the dollar would have kept its strength. But again, it goes against these comments. But is that just a market reading one thing one week and another thing another week?
Yeah, for one, but I think he's just once again walking the either the fine line or both ends of the spectrum, like as if can go up and can go down. You know, everybody is data dependent, and perhaps the what's going on in the market is they say like when he's not hawkish, he's dovish. You know, but I think independently from that, and you can hardly call it dovish, but the fact that he and again I'm coming back to the same thing, the fact that he speaks now again about the dual mandate is telling the market something, that it's not solely inflation that we're trading anymore, or that we're looking at anymore. So inflation could in fact remain slightly sticky and them still starting to cut rates, because they have said everything, right? Either it has to be sustainably around 2%, but then at the same time they're saying, or the next line they're saying like, but it's sufficient that we're going towards 2% to start cutting, and that's where confused is maybe not the right is maybe the right word actually, but yeah, the market is looking a bit confused and needing to shift its attention now to the job market at an equal ratio to inflation. We've been trading inflation for 2 or 3 years, because the rest was doing like extremely well. So now we have the uncertainty about the jobs market, and we were talking about that. We talk about that every day in the room. So we were talking about that this morning as well. And it feels to me like now the market is ready to slap the dollar on any weakness seen in the labor market because of his speech last Friday. And well, that's what I've been saying for a long while now, is that the job market being such a big domino, if that starts to tilt a little bit, there could be trouble ahead, for at least temporarily, for the dollar. And it seems that we are now in this uncertainty zone. Okay, so you're not only trading, or you're not trading 80% inflation, 20% the rest. You're now trading 50-50, and that's probably one of the reasons why an overly confident dollar bull market has to really rethink once more. We're in this constant repricing still, and correlations are how shall I say, random at best. Once they kick in force, and then the next day there's not one single correlation working anymore. So we're still in this uncertain period, which is somewhere what I've been saying since the start of the year. We had this first quarter where the dollar made the comeback. It lost everything. It lost a lot over year, and now it made a lot of it back. And now we start in Q2, and Q2 could be the first part of Q2. We could be in a scenario like we're seeing right now, up and down and up and down, and then towards the end of Q2, decision time. I'm still in this global scenario thinking, yeah, we could see a lot more. It may be volatile, but still remain in ranges somewhere.
Yeah, I mean, at the moment it's good volatility. You know, there's bad volatility and there's good volatility, and this is good volatility because it's giving you the moves around the ranges. You know, if you look at euro dollar, you know, my big level was 107. We've kept that range. We had a prior level 107.20, 25 that held. Now we're holding the 107.60 again after breaking below it, busting up through the zone, but finding it tough up here. So it's given us decent ranges to play. If you can trust them. The problem is you can't get too scared out.
To one idea.
Yeah, exactly. You know, if the euro's been falling for, you know, the best part of half a month, you can't think, oh, right, well, this is it. It's the end of the world. Euro's going to the 105, going to parity, because, boom, it just slams into the market, says enough's enough. It hits a decent level, and then it goes the other way. In the same way we climb back here, can't think it's going to 115, because, you know, it's probably going to run into trouble into the 109. So good range playing. I mean, the dollar yen, that's out in its own world still. So, you know, I'm still not inclined to touch it, unless I get some headline related dip to buy or something. But I'm still fearful about shorting up here. I'm fearful about maybe trying to break trade. So yeah, this one really is still just let it do its thing. I'm going to sit back with a popcorn and watch it.
Too much of a touchy level, this one.
Yeah, exactly.
It's too much. It's too much. We've seen the dollar. Okay, let's say we've seen the dollar ex yen ex Swiss. We see the dollar like lose 1%, and this one's still hanging around there. And I've been talking about it on the flows. I mean, this could really trade any type of scenario, really. Could take out the 152, rally to 153, even 154, and then the MOF wakes up and says like, well, hey, hang on a little bit. The yen is getting absolutely hammered here. Why would dollar yen be up when the rest of the dollars are lower? And then all of a sudden intervene and you find yourself at 148 or 147, I don't know. Or you could have like a trigger of the 152 and then all of a sudden reverse and you find yourself at 150 and a half. And it could be really anything. Or we could just hang around here for another. I suppose, or I could imagine that tomorrow over the NFPs we are going to make a decision for this one. But in the meantime, it's just trading, as I said. I mean, it's trading around barriers. We can't touch the figure, and it's not going below 151 and a half, 151 quarter, because the same defenders are buying back the lows. That's exactly how I traded and how I saw barriers trade when I was in banks. This is the scenario, you know. And that makes it all very uncertain about what's going to happen around the figure once it probably sooner or later it probably will trade. But I mean, it makes it very uncertain to know what's happening around here. So I'm not having any cash. I'm having just my option and I'm trading around it, and that's it.
Yeah, I mean, this has got to be the biggest barrier action I've seen in years. Up here, you know, I've not seen anything like this for years. Hence why I'm still leaning to the possibility that there's official interest up here, because it's not, and it's a funny number, 152. You know, you'd expect it around 150, and we saw barriers around 150 last year when we got up here, and we've seen action there. But it's really quite something. This level, really quite something. And
but you know, I mean, funds, asset managers, even some of the Japanese companies, there can be a load going on, you know, and those things are not reported in whatever CFTC or the other reports that we see. They are not in there. That is what I've been telling people as well. I mean, if you look at stuff like the COT, CFTC, or there's a lot not in there. What's going on in the market? I mean, imagine you. We were talking about those big barriers that we had in the past done by China. They are not going to appear in any report, you know. But they can have like 5 billion sitting. A $5 billion barrier sitting at 152. I mean, if it's one of them, even the big hedge funds, you know, they can do loads. They can do really, really big amounts.
Yeah, very much so. Just usually we find them on the other side trying to push the buttons of the MOF and whatever. But it's.
I think the risk is real. I think If we would have seen a gradual rise of the dollar across the board, I would have said like, nah, there's no way they are going to intervene before 155, 160, even just taking those rates as an example, because we have to know they don't have like a fixed rate in their mind. But today, with the rest of the dollars being under the cosh, I'd say it heightens the risk if we get a fly through and a spike of 100 points if we get through, because we can imagine there must be tons of stops lying just above there as well.
Yeah.
If 100 points fly through, I wouldn't really rule it out. I would really not rule it out.
Yeah, well, it's going to be another interesting watch. And again, and then the other side, if we get a really strong NFP and it can't break it, well, that's going to make the level even bigger.
Yeah.
But yeah, it's a good bit of watching. Not that I'm that interested in trading it right this minute. So yeah, right. The only other headline I've got, maybe something to watch out for. Air France pilots are calling for a broad strike. And they're protesting, quite ironically, about a government bill which is trying to limit the right to strike in the transport sector. So it's nothing to do with pay or wages, whatever. But as we know with France, if they get a bee in their bonnet over there, like with the farmers, they will crank things right up. So it could lead to other strikes coming into play, which then has its economic implications. So that's just a headline that caught my eye from yesterday. Right, that's all I've got on the headline front. SK, you got anything? Or were you obviously covering more than I saw?
The rest is all opinion pieces and stuff. I saw one of the Bridgewater co-CIO saying that the dollar is too high and gold is too high. But then, I mean, those. I don't know. I don't have anything else, mate. Move on.
Thank you, mate. Right, I'll knock up the link to the NFP competition. That's there in the Zoom chat now. So if anyone hasn't had a guess yet, get your guesses in. Lucky prize, 3 lucky prizes or win 3 prizes for lucky winners. They're free month on the ForexAnalytix platform. And don't forget to join us on the F.A.C.E show on Friday, where we're making a significant announcement. If you're not registered for F.A.C.E already, then you can check out the link on our website, ForexAnalytix.com. If you're already registered, you don't need to do anything. Just turn up and get ready for that news there. Right, so let's have a quick look around. And it's, sometimes it's easier to, when you're not watching markets, when you're not fully focused on markets, it's easier to see things maybe a bit differently. You're not in the noise and everything. I come in and I've only had brief looks at the charts or whatever, just make sure my positions are doing okay. But for this one, it's the euro. It's keeping the trend going. 107 was my key level down here. If we were going to start breaking this trend, but it's still going, or it's looking like it's still going. We're sitting pretty much just above the middle of it at the moment. So it's still a bit 50-50 which way it goes. But it's certainly looking not as bearish as it was a few days ago. This is why I highlighted last week this 107.20s area, just as another area to keep an eye on. And that's where we found the bounce from. James is saying it looks like a bit of a pivot on euro dollar, quite possible. If we hold below this 108.70, the top of this zone, like we did previously, then that may keep this downtrend intact. So it's trends within trends within trends. As I said, also looks like an Elliott Waver's wet dream, this one. So it needs to get above this zone, and then maybe we have another crack at the 109s. It will need to take out these highs to continue the overall uptrend. Then all these look like a bit of corrections going on. So let's see what happens with the data to come. Again, where we finish the week is going to be important. It seems to be important every week now where we finish the week, whether we're below a level or above a level. So if we're above 108.70 the end of this week, then, as I say, maybe we're going to have a crack at these highs. And if we take them out, then we're going to have probably a run to 110. and then maybe we ever think about maybe running a bit higher. But if we don't, that'll keep this downtrend in play, and maybe we do go and have a look at the 107 or even lower. But the levels are showing up. They are playing nicely. Cable, I was hoping we would get a move down to the lower 125s, maybe even the 125 itself. But again, it's held up at some of these levels just above the big figure. So it's keeping this intra range, shall we say, away from the bigger range, 125s, or 125 and a quarter, and then down to 125 here. So keeping the wall from the door. Bounces though limited around this. This is a bit of a pivot level. Not really one I'd trade 126.70s, but it seems to be one where if we're below, we head lower. If we're above, we head higher. But this one is staying firmly within that range. Again, this one was looking weak. Seeing people talking about 123, even worse. Couldn't even get to 125 before the bounce. So that's why you can't get overly biased one way or another. Don't get sucked into the rhetoric, into the moves, into the commentary that you'll see on Twitter. You know, when something's falling, it's the end of the world, and it's going here, it's going there, and it's going another 500 pips. And then everyone gets short at the bottom on the fear, and then boom, that's when you get kicked in the arse. So trade the levels, not the rhetoric. Euro sterling. Here we are again. Looking like it was going to be heading lower again. Maybe another test of 85. Couldn't get there. Now we're back up. Mooching around this 85.70s again, which is being a bit washed out at the moment. So it's not really a level. Again, it's sort of a pivot level, but as I say, it's becoming a bit messy. So going to probably ignore that one. It's all becoming a bit messy in here. I see no reason again for a move in either direction. We know where Europe is at, we know where the UK is at, and the market is seemingly well priced for that as well. But I would keep an eye on that UK data. It has been green shooting of late, but is it going to start turning a bit softer again? And we'll see where that affects the quid, because that's going to affect this pair, obviously. And all those green shoots in Europe as well, you're always going to find that Europe will outweigh the UK. Yes, mate.
It seems to be the cross to express the possibility of a bit of a softer Bank of England starting to show up. That's I think the reason why we keep on rebounding. It if anything, I'd say this could be one that if there is a shift in BOE sentiment, a decent shift in BOE sentiment, that could probably push up a little bit. It's all very rangy. It's all very in the bigger scheme of things, very quiet on this cross. But forces to admit that it's holding those lower levels, right? So I think that's going to be for sure a cross that's going to be affected by Bank of England expectations going forward. Not really knowing which side, but it just does appear to me that it won't need too much of a softer tone to start ticking higher again now, up to where I don't know, but it's one where for as long as 85 holds, don't fight it. I'd say in the more medium term.
Yeah, thanks, mate. Now I'm going to have a quick look at S&Ps, and I shall turn it over to K-Man for some of his input. I'm still chewing over a lot of my charts. This one had another little blow off. Let's get rid of some of this stuff going on here. Just clean up. See, I'm not even cleaning my charts up yet. Yeah, had a little bit of a blow off and then a decent pullback, and it did what it needed to do. Finally, it retested the support area. Remember, I was saying this is a bit of no man's land in here, what it wants to do, and look where it stopped, right on the support. You know, this is why you need to build your price picture as it's going along. Then you find out where the places are, where the price needs to do something, whether it's going to start showing it's breaking down or whether it's going to keep the trend going. So it's done its job, held right in that area there, and now we've had another bounce back up. So it keeps this momentum going. That high, even though it looks a bit of a blowout and we had a big loss from it, that now is looking like a decent refresh of the trend, which is what you need in trends. You need good refreshes, and we've had them all the way along. Higher, 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 refresh, refresh, higher. So it's keeping the momentum going. Now we need to see what it does up here. Do we find resistance again in that first area that we made the top, 52.60s? Do we find resistance against the recent high up in the 80s? If we find a resistance below at the 60s, then that's going to maybe indicate we've got something a bit more stronger in terms of a top, because we can't quite get up to that high again. So the sellers are protecting that high. Then maybe we see it coming down to test support again, or going a bit sideways. It's going to need a break of support before shorts can really grab this by the horns and push their case, because they still keep getting short and then probably getting knocked out of their stops on the way back up again. So still undecided here, but the levels are being defined. So if we break above 52.80s, then we're probably heading for 53 and the trend will continue. But technically doing all right. I'm still holding a little bit of longs, so it's nothing's changing here in terms of how the trend's behaving for that one. Kay, do you want to take it over, mate? I could do with hearing some analysis, updated stuff. There we go.
Okay, I need to get back to go back to the sterling, because people on who were in here yesterday and who were on F.A.C.E, I told them, like, say, if there's any wobble in the dollar or anything, this one could be in for a bit of a bounce. And I said, like, up to 126 or perhaps 126 a bit above, and that's where we are, just because of this, this red line here. I spoke about that. Brand, you remember, right? And so down to 125 support area. I know Ryan already spoke about it, but I just want to reiterate what I showed yesterday. Yesterday we were trading around here. So when I say respect that area, the market has respected it, and we are creeping back up now, or at least well, a little bit faster than creeping back up. This is a bit of a prior high around here, but I would really think that the more solid resistance would come in from 126.90 up to 127.20, and then we have like a more longer term trend line coming in here. Okay, the head got a little bit cut off. Oh, it's actually, should I put this lower? Between the daily and the 4 hours. What? Why is that? And that's gonna come in around yeah, closer to 128, and then closer to those that last high here again. That is in case we get weaker numbers. I wouldn't say today necessarily. I think today could be a bit of a transition day. Okay, we have the initial claims out, but unless there is like one huge surprise over there, it's not gonna move too much. I think we are in a little bit of perhaps a transition day today. Reflect on what's happened on the rejections of some pairs, and then see what's going to happen tomorrow. But there's been very interesting developments on the Aussie. Yesterday as well, I was saying respect 64.80, and I think 64.80, as I said, was my bigger level than 65 actually. But then we didn't go for a retest at all. I tried to shyly play against this zone here, 65.25. But then after the data, and then when the Aussie started to move higher, I cut my short for a minor, like 20 pips or so loss. But that's all right on a small position. Sometimes we have to be reminded that we are not invincible, right? And now we are already breaking above this trendline resistance, which is 65.90, and we are up into the next small resistance zone. Okay, that shows you how fast things can change, because it was looking quite offered. This was looking like a consolidation as well before trying to re-attack the downside. Nothing of the likes happened, and we are flying back up. So then you look at stuff like copper and so, and you say, like, well, it's logic that the Aussie is higher, but copper rallied well before the Aussie. So this seems to be catch up and people just being short Aussie. A lot of negativity had been thrown at the Aussie or the Kiwi over the past sessions, but that is probably due to positioning and people needing to get out of it. Okay, yeah, Ali, and a lot of people were in the same boat. You know, a bit of overconfidence on the dollar perhaps, and we have seen what that can do, right? Kiwi never made it to the 59, the figure zone where I thought it may go. I didn't have anything in it anymore. I covered them way before actually this move started. But this is crawling back quite a bit. We are trading around the 60-40 prior low. We are around there. Actually, we are bang on it. I'd say keep an eye on what's happening for a starter around 60, 65, 60, 60, 70. And then here we are going to have a bit of a crossroad if that would move up, and that's 61, the figure, which is also a prior high around there, 05, 07. So around 61, the figure is going to be an important one. And that also is already thinking about probably tomorrow. I don't see anything unless the dollar is, the market is really getting traumatized by its dollar loans. Anything to really drive it through today. I think we consolidate a little bit. Could go back down to 60, the figure, even without changing much. And then we have to. Oh, by the way, I covered my Euro mix yesterday, and for a couple of reasons. I know we are still in a very negative environment globally, but then yesterday, against my somewhere feeling, the euro was a bit too resilient. We had those PMIs, as I was saying, like they perhaps shoots, but we still have to decide whether they're green shoots or not. But then yesterday, with the dollar coming off, traditionally, euro emerging market or euro versus what is close to the US, in this case, the Mexican peso has a tendency of creeping up a little bit. The dollar mix hasn't moved much, but this one I just took it off for now, and I'm going to wait to see if we can make it back somewhere above 15, above 18, towards the low 18s, 18.15, or even 18.20 or so. We do have consumer confidence out a bit later in Mexico, and also the monetary policy minutes later, a policy meeting which was extremely neutral. Okay, it wasn't dovish at all. It was extremely neutral. So we will have to see if there's any other details coming out of there. And then very quickly, because I'm looking at the clock as well, very quickly looking at the Swiss charts. We are powering on after the lower than expected Swiss CPI. So don't change the winning team. I think this is still looking quite good, and Euro Swiss is likely on its way to high 98s, low 99s. I do think, as I said already earlier, that there is a possibility that we undo this whole move, but I'd say keep an eye on every like 5-10 points around the big figures. If we clear this one, and I see little reason not to, but always, you know, positioning and things, take it into account. I see little reason not to go to parity at some stage. Same thing on the sterling Swiss. We have held this crossroad here in the low 114s, and now we are gradually moving higher. Bit of a zone coming up here, 115 and above for the next big figure and a half. I'd say keep an eye on what's happening there, because we have prior highs that we need to take into account. Okay, and the late 2022 high, especially if we would make it up there, I think we need to pay close attention. I'm still long. I'm taking bits and pieces off. I like this slice and dice theory and the the way of trading. Now, if it goes back a little into the low 114s, high 113s, I can try to reload a little bit. Dollar Swiss, different, a bit of a different one because the dollar, because of the dollar, the dollar in itself is showing signs, and I'm not going to say of real weakness, because we're still turning around this trend line here, but I'm a little cautious. I'm cautious. So I've decided yesterday. I already took some off before the US data, and then on the rally this morning I just decided to took the rest off around this trend line here. I still think in the medium term we are going to at least get back to the end of year highs around 92.5, but I want to be cautious just ahead of tomorrow's labor data, because they are so important. Okay, and it's better to take the money and then sit back and wait. We can always surf another wave when needed or when warranted. But on the dollar side, I decide to be a little bit cautious here. And that closes my votes for the day. Back over to you, Ryan.
Thank you very much, mate. Thanks for all your valuable insight as usual. I haven't even seen what we've got coming up today. We've got much coming up today in the US.
The claims, but yeah.
Yeah, claims, and that's about it.
Yeah, Barking, Goolsby, Mester, we know already, right? She says she's still in the three cuts camp, but patience to wait. And she actually, I think she or Dani said June is a likely scenario.
Yeah, thanks, mate. So yeah, not a lot of data out, but those jobless claims we watch closely, even though they're after or later than tomorrow's NFP. The market might still have a little move if there's a big variation. So anyway, that's that for today. Thank you very much for coming to the Flow Show. Don't forget to enter the NFP competition, and we shall see you all tomorrow for NFP Friday. Have a good one, everybody.